Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hello, Jim.
Danielle, for all the people who have made loads of money either in the stock market or in real estate or even from stimulus checks, is this wealth going to stick around?
Well, this is the thing, and the historical references that we have for what's been going on would suggest the answer is no, that they're very transitory. And that is a problem because if you look at the spending that has come, the borrowing and spending that has come on the backs of these wealth effects, so to speak, these increasing asset prices, what happens is that when the asset prices mean revert, when they go back down, the debt does not, and I've mentioned this many times. So you see that, any bump up in interest rates is a problem when people have levered themselves so highly. I was just reviewing some recent data from, where I live north of Toronto. Housing prices, as I've mentioned before, are up something like 27% in the last year. Even more than in the Greater Vancouver area, for example, where they're up something like 5.5%. And in Toronto, they're up like much less, like 8%. But still, we were already at record valuations and record price to rents and that sort of thing. So it's been, in terms of price to income ratios, we're right off the charts here. The average Canadian home price was $621,000 in January, and the average household income is something in the area of $75,000. So when you got a national figure that's pricing homes at 8 times household incomes on average, and much worse in places like where you and I live, we're talking 10 times plus incomes. All that really does is just suck money away from every other thing that people could use it for. And also for savings potential, right? So if people are now going to spend the next 30 years just trying to pay for their shelter, they have a lot less funds for everything else. And they're also extremely vulnerable to any correction in price. And this is something that people fail to understand, I think, is that when you've got, housing corrections typically have always the worst economic impacts because it is the most widely owned asset. So any kind of mean reversion there typically takes away not only consumption ability but also wipes off net worth, and it causes a downturn to accelerate in the economy. So now we've got these, sort of two towers of terror. We've got equity prices, which have gone on this berserk move higher, at least into February when a lot of the really crazy stuff was topping out. So you've seen this big rebound there in the past year and as well in real estate prices. So, those two things correcting together will be a very big negative for household balance sheets, but also for the economy overall. And any kind of bump higher in interest rates, which we've seen in the last couple of months, is hard to absorb when people are as highly levered. And we're talking about homeowners, but we're also talking about investors in the space, and we're also talking about people who have borrowed money to buy into the stock market, which is at all-time highs as well. So it is a very big issue because in any scenario, whether you got a rebound from the pandemic, whether it's quicker than quicker than I expect, or maybe it goes better than some of the more realistic estimates now imagine. Still, you've got this problem of this extraordinarily over-levered household balance sheet, and the fact that jobs don't come back quickly. So jobs typically take years to recover. And we've got this huge hole in the balance sheet in terms of many businesses for, lost revenue that they have not collected, debt they've gone into to keep afloat, and the same has gone for households. So the two things correcting together are a big problem, and that's kind of a base case scenario from here, whether the recovery is, even if the recovery goes well, but what if the recovery goes slower than people are hoping? And this is something that I pay a lot of attention to, because I know we've had such extraordinary optimism since, the two leading vaccine candidates were announced, back in November. But now we've got these other variants, which you and I have talked about before, the South African variant, the Brazilian variant, which is having lots of opportunity to morph as the world struggles to get these vaccines out. And, we've got a report out of the University of Washington this week who have been very prescient in forecasting the transmission rates of the pandemic around the world. And we're also very optimistic when the vaccines were announced. But they are now adjusting their forecast based on the quick spread of these other variants, which are not as easy to contain by vaccination and in fact seem to be quite a different beast. So they're now downsizing their expectation for whether we can actually get the COVID virus contained, in fact saying it may well be an endemic virus that just continues to circulate in communities and cause all kinds of ongoing illness and death for years to come. I mean, these are not alarmist people. These are the people who have been actually optimistic about the vaccine's potential. So, you layer in all these things, I think we've got way, way past any kind of reasonable expectation of how this recovery goes. Asset prices have just gone delirious. And it's really interesting that we're starting to see a correction's been happening stealth under the surface in the tech sector starting in February, but it's really picking up steam now. So we can certainly talk about what impact or insight that might be giving us.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. As you said before we went to break, the tech stocks have slowly been sliding downwards. Are we seeing a repeat of the 2000 .com bust?
Well, slowly and then all at once, right? I was just checking. So NASDAQ as of today has given up any gains it made year to date. It's into the negative territory. Some of the hot stocks that we had talked about many times, Tesla, for example, is off 30% since February. The marijuana life sciences ETF, which is in that sort of biotech space, is off 38%. DoorDash, where everyone was buying food and having it delivered, that's off 42%. The gold and silver, the commodities off quite a bit, but the actual miners have dropped 33%. So there's really been a quick change in the trend. We were talking about IPOs and how crazy the appetite for IPOs was in the sort of latter part of 2020. That is also typically indicia of a market top, a frenzied buying mania that comes to its logical conclusion in a big correction or big bear market. So the Renaissance IPO ETF is off 20% since February. The SPAC index, which is, again, the special purpose acquisition corporations that we were talking about, where people were just getting blank checks from so-called investors who are actually not doing any due diligence, just throwing money at whatever, that's off 20%. Amazon's off 15%. So these are the things, the companies have been making a killing during the pandemic, and they're also caught up in this downdraft. So I think it is all part and parcel of, the speculative frenzy that took place in the last year that caused people to reach for risk, that caused people to borrow money they couldn't afford to lose, to wager on these speculative bets, whether it's in the real estate market, whether it's in securities markets, and ultimately it's always ripe for disappointment because nothing can ever be perfect, right? And when you're priced for perfection and you're borrowed for perfection, it really doesn't take much. Like just I was thinking about the math of that, back to the housing stuff. So if you're buying $1 million house and it goes up say $1 million house goes up 25% in a year, so it's now 1.25. You put a 20% down payment on that. If you get a 20%, that's a $250,000 down payment. Just a 20% correction would wipe out the entire down payment that you put on and mean that you've now got negative equity in your house. So that's, for people to have a $250,000 down payment, that's a lot of money for most households, given the average household income stats. And even for the higher household incomes to come up with that kind of cash down and then have it evaporate in a matter of weeks or months because they bought high and now we're in this correction phase, that all has very significant impacts. And the same goes for these violent moves down in tech stocks. And like you pointed out or alluded at the start there, we saw an 80% correction in the average basket of these shares. The tech favorites, the darlings that could do no wrong in 2000, they dropped 80% on average. Many of them went bankrupt, but even the ones that were sort of solid companies and continued to be world leading in their particular area or sector, they were, as I say, down significantly and took 15 years to recover. That's really the kind of environment that we've set ourselves up for in this particular market cycle with all the craziness that's gone on.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is the money people have saved up for retirement in danger?
Yeah, of course, because the way that the world works in this space is that there is a whole obsession with trying to track indexes, right? So the indices themselves, which are considered these diversified baskets, whether it be the S&P, whether it be the TSX, these are typically what most mutual funds are designed to replicate. So they never raise cash more than a few percent. They're always fully invested. And regardless of when a person happens to come into the market cycle, whatever cash they have, whether they sell a business, whether they inherit money, whether they're just making a catch-up payment to their RSPs or their TFSAs, whenever they happen to get the money, it gets tossed into these baskets or portfolios, which typically replicate these broad indices. And sometimes they're much more sector concentrated than even the broad industry, right? So people have a bad habit of chasing what's been hot. So if they, they're making a contribution to their RSP, they think, oh, tech's really on fire. I'm going to put this into a tech fund or a NASDAQ fund. And as I say, within a matter of days and weeks, you can see that you've lost 20 to 80% of your money. That's just run-of-the-mill stuff in this kind of environment. But also, some of the largest funds held within retirement accounts, a lot of people think, well, I'm not a stock picker. I just use, very diversified conservative mutual funds. Unfortunately, with the extraordinary amount of elevation that's taken place in these holdings, and the pricing that's become so disconnected from anything mildly related to math or investment metrics, what's happening is that they are now huge weights. So the mega cap tech stocks make up about 30% of the sort of benchmark funds that many people hold within their retirement plans. And they don't realize that they're so exposed because they think of them as this sort of diversified holding. But if you get, an 80% decline in 30% of your portfolio, that leaves a hell of a mark. And that's the kind of thing that we've really set up for. So as I was mentioning about, the shares that are taking a big tank, the Apples, Microsofts, Amazons, Facebooks, these are the ones that are currently in a major correction cycle. And never mind the NASDAQ, which is heavily weighted in tech, just the S&P 500 was 24% comprised of just these, 5 tech companies before this sell-off started. So again, as I say, it's very important to look under the wrappers. There's a lot of glossy marketing machine around all this. They put fancy labels on. They call things, conservative dividend paying. And inside of that, it can be everything but conservative. Everything matters about the price paid for the entry point. So no matter what the wrapper says, no matter what the person selling you the fund is telling you about the marketing around it, if the pricing inside is extraordinarily high, as it is now, that means your downside risk is enormous.
Is this a great time to review your financial plans, and where can you get some honest advice from somebody who isn't trying to sell you something that may have a conservative name but is actually risky?
I wish it was really simple to tell people how to get good, unbiased advice. I have struggled with this for my entire career because I get contacted constantly. Our firm has a household minimum of $1 million for the work that we do for individuals, and there's a lot of people out there who say, hey, nice, but I don't have $1 million. Who can I go to get an independent review or some, good advice? And unfortunately, it is extremely difficult to know where to send people because we live in not only a sales-driven culture, which most of the people that are giving, quote, advice have these built-in incentives to get people into equity products because that's where the fees are the highest. But you've also got, in this cycle in particular, a lot of people that should be independent, like, for example, accountants or estate lawyers. Many of them have developed these referral arrangements with these financial types who are also sharing the fees and giving, kickbacks and that sort of thing for referrals. So when you've got this whole equity culture dominating what everyone's doing, very few people have the incentive or the ethical interest in pulling back and looking at it and saying, okay, without racing to what product we should put you into, let's have a look at your overall financial picture. Should you have, should you even be putting anything into the stock market, or should you be paying off your house? Should you be holding some government bonds or GICs? What is the purpose of the money that you're saving? So those kind of big picture assessments are critical. And, Rob Carrick was writing in the Globe recently, just about how, when he goes looking for similarly that kind of service somewhere for people, because he also gets asked these questions since he's a financial columnist, and people are saying, where can I get an unbiased review? And he was recently writing about how, there's some algorithm products that you can find online, but also ultimately they tend to serve as just conduits or sales tools to direct people to people who want to get them back into equity products. So it's extraordinarily difficult. That's why I try and educate the individual to say you need a top-down look. Don't let yourself get pulled into the craziness of crowds. First of all, manage your own balance sheet. Try and get your house paid for. If you're in a place where housing is unaffordable, then don't take the bait and put yourself into extraordinary stress and strain to try and keep a shelter over your roof, over your head. Figure out a way to live in a cheaper way and build up your savings buffer. And while you're building your savings, number one mistake people make, if they're, for example, accumulating funds for a house fund, and they're saying, eventually we hope to buy a home with this in the next couple of years, and they go and put that into the stock market. That's completely the wrong thing to do. Don't put any money in the stock market that you can't afford to lose, or that you don't think you're going to need for at least 10 to 20 years. So, just that alone, if that kind of advice was given to people off the top, a lot wouldn't even end up putting the money into these mutual funds or, so-called equity-based portfolios. So there's a lot of things the individual can do. That's why I write the blog, jugglingdynamite.com. I put all kinds of information and links on there. People contact me through that from time to time, and I try and direct them, in the sort of right areas of what they should be thinking about. But it's ultimately, like an act of service just to try and help, because we live in a world that's so conflicted. So many conflicts of interest. Now, coming down the pipe, we have this initiative worldwide a few things are giving me some hope. One is that there's a crackdown globally, both in the Europe and UK and Canada and the US. The focus of regulators, which is, has been extraordinarily lax in the sense the financial sector's basically had its way with whatever it wants and wrote all the rules, took out all the roadblocks, and made a complete mosh pit of the whole thing. That's partly why we've got so much risk in the world system right now. And so now we've got a pendulum swinging back. This is a feature of history, right? The pendulum moves back and forth from one extreme to another. We've been in this extraordinarily lax period, and now we've got a push regulatory-wise for greater oversight, for greater reporting of conflicts of interest to clients, of curtailing that kind of behavior. We've seen, for example, in real estate markets in New Zealand and Australia, they brought in new rules recently which said that you have to have a 20% down payment, and if you're an investor, you have to have a 40% down payment. There's been talk out of, Simon Fraser University. There's a professor there that has been quoted by the federal government in Canada about the need to actually get home prices down instead of trying to figure out ways to get people into them with less and less down and to borrow it more and more to be able to afford it. How do we get home prices to start reversing? And the tools that they come to is you have to, tax speculation, tax foreigners, put a national tax in place, something like they tried in Vancouver, and also increase the down payment requirements so that people can't get as levered, so they have to build up savings more. And all those things have the effect of bringing prices back down. So there is intelligent things that we can do policy-wise. There are self-preserving things that individuals can do, but it takes thought, and it's a lot more than just glossy brochures or sales pitch stuff. So people really have to develop some personal discipline around their money.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.